Equinor's fourth quarter and full fiscal year 2025 was characterized by a juxtaposition of record-shattering hydrocarbon production and a strategic retrenchment within its renewable energy portfolio. Analysis of negative aspects and strategic risks. Notwithstanding its successes, Equinor faces challenges. Renewables economic strain. The USD $1.61 billion loss in the renewable segment highlights the persistent profitability hurdles in offshore wind. Regulatory risk. The repeated suspensions of Empire Wind create permit uncertainty that deters future investment. Reserve replacement decline. The drop in the reserve replacement ratio to 48% indicates weaker replenishment of produced volumes. Natural decline. The Johan Sverdrup field is expected to see a production decline of more than 10% in 2026. Analysis of positive aspects and competitive strengths. Equinor's 2025 performance reveals several fundamental strengths. Operational superiority. Achieving record production is a result of successfully bringing complex projects like Johan Castberg to stream. Resilient cash flow. Generating USD $18 billion in operating cash flow after tax, despite price drops, demonstrates high asset quality. Strategic high grading. Divestments in Argentina and the Adora JV maximize value from core international offshore projects. Equinor's financial results for the 2025 fiscal year demonstrate a robust ability to generate significant cash flows despite a marked decline in realized prices compared to the historical highs of previous years. For the fourth quarter of 2025, the company delivered an adjusted operating income of USD $6.20 billion, representing a decline from the USD $7.89 billion reported in the fourth quarter of 2024. This 22% year-on-year reduction in quarterly earnings was primarily driven by the softening of liquid prices, which averaged USD $58.6 per barrel during the period, a 14% decrease from the same quarter in the prior year. However, the resilience of the company's portfolio was evidenced by an earnings beat, with adjusted earnings per share of USD 81 cents, significantly exceeding the consensus analyst expectation of USD 64 cents. The erosion of bottom-line profitability was not merely a function of commodity pricing, but was exacerbated by significant net impairments totaling USD $2.48 billion. These impairments were concentrated within the international upstream and renewable segments, reflecting a more cautious long-term outlook for offshore wind in the United States and updated price assumptions for global oil and gas assets. Despite these accounting write-downs, the underlying cash-generating power of the company remained robust, with cash flow from operations after tax reaching $18 billion for the full year. Management has indicated a desire to run with a solid balance sheet while maintaining competitive distributions, implying a potential cooling of buyback activity in subsequent periods to manage the increased leverage resulting from capital intensity in major projects like Johan Castberg and Bacalhau. Operational performance served as the primary catalyst for the company's financial resilience during 2025. Equinor achieved a record-breaking equity oil and gas production of 2.137 million barrels of oil equivalent (MBOE) per day for the full year, a 3.4% increase over 2024. The fourth quarter was particularly prolific, with equity production reaching 2.198 MBOE per day, representing a 6% increase year over year. Regional production contribution and segment analysis. The Norwegian continental shelf continues to function as the operational heart of Equinor, providing high-margin production that benefits from a stable regulatory environment. Key regional production performance includes ENP Norway. Production rose 5% in the fourth quarter to approximately 1.42 MBOE per day, driven by the ramp-up of the Johan Castberg and Halten East fields, which helped offset unplanned maintenance at the Johan Castberg facility. ENP International, ex-USA, recorded production of 337 MBOE per day in Q4 2025, reflecting a decline attributable to the divestment of assets in Nigeria and Azerbaijan, and a production halt at the Peregrino field in Brazil during its transition to new operatorship. ENP USA emerged as a growth engine with 441 MBOE per day in Q4 2025 and an average of 430 MBOE per day for the full year, benefiting from the acquisition of additional onshore gas assets in late 2024.
Total equity production averaged 2.198 MBOE per day in Q4 25 and 2.137 MBOE per day for the full year 2025. Exploration activity on the NCS remained successful, with 14 commercial discoveries recorded in 2025, 7 of which were operated by Equinor. These discoveries are primarily located near existing infrastructure, allowing for rapid and cost-effective development through subsea tiebacks, which is central to the company's strategy of maintaining production levels on the NCS through 2035.
The 2025 results for the renewables segment highlight the stark realities of the global energy transition. While power generation from renewables increased by 25% for the full year and 42% in the fourth quarter, the segment remains financially challenged. Total power generation reached 5.65 terawatt-hours for the year, largely driven by the ramp-up of the Dogger Bank A offshore wind farm in the UK and increased onshore renewable production in Brazil and Poland. Despite the growth in physical output, the renewable segment recorded a net operating loss of $1.61 billion for 2025, primarily due to $955 million in impairments related to U.S. offshore wind projects. These write-downs reflect the cumulative impact of inflationary pressures and supply chain disruptions. The establishment of a new power business area in the fourth quarter of 2025, effective January 2026, aims to integrate renewable generation with flexible power assets and trading. A pivotal moment in the 2025 fiscal year was the recurring suspension of the Empire 1 project off the coast of New York. In December 2025, the Bureau of Ocean Energy Management issued a stop work order citing national security concerns related to radar interference from the turbine structures. This was the second such order in a single year, following a similar halt in April 2025. Equinor initiated legal action, characterizing the suspension as unlawful. On January 15, 2026, the U.S. District Court for the District of Columbia granted a preliminary injunction, allowing construction to resume while national security claims are deliberated. The project, which is more than 60% complete, represents a $7.5 billion investment and is critical to New York State's renewable energy targets. The legal victory was a significant positive catalyst for investor sentiment, although the ongoing threat of appeals remains a risk. The most consequential strategic announcement accompanying the 2025 results was the decision to reduce the organic capital expenditure outlook for 2026 and 2027 by $4 billion. For 2026, organic capex is estimated at approximately $13 billion, falling to $9 billion in 2027. Crucially, this reduction will be primarily absorbed by the renewables and low-carbon solution segments, while annual oil and gas investment will be maintained at a steady $10 billion. This realignment suggests that Equinor is moving away from its previous ambition to allocate 50% of its growth capex to renewables by 2030. Instead, the company is adopting a disciplined and value-driven approach, focusing on executing already sanctioned projects while maintaining the robustness of its core hydrocarbon business. Portfolio high-grading was a prominent theme throughout 2025. In December, Equinor and Shell completed the formation of Adura, a 50-50 joint venture that integrated their UK offshore oil and gas assets. Adura manages 12 producing fields and is expected to produce over 140,000 BOE per day in 2026. The venture is designed to be self-funded and delivers economies of scale in a mature basin. Additionally, in early February 2026, Equinor announced the divestment of its full onshore position in Argentina's Vaca Muerta basin to Vista Energy for $1.1 billion. The transaction includes a $550 million upfront cash payment and Vista shares.
Equinor continues to prioritize competitive capital distribution as a core pillar of its investment proposition. In 2025, the company distributed a total of $9 billion to shareholders through dividends and buybacks. For the fourth quarter of 2025, the board proposed an increased ordinary cash dividend of $0.39 per share. The distribution framework transitioned between 2025 performance and 2026 guidance as follows. Ordinary dividend, quarterly payments ranged from $0.35 to $0.37 in 2025, with a base plan to increase to $0.39 in 2026. Annual share buybacks completed $5.0 billion in buybacks in 2025, with a guidance of up to $1.5 billion for 2026. Total distribution reached approximately $9.0 billion in 2025, while the 2026 commitment remains subject to market conditions. This 70% reduction in buyback activity reflects a shift in priority toward protecting the balance sheet during a period of heavy capital expenditure and lower commodity prices. In conclusion, Equinor remains a highly resilient and cash-generating energy major. The fiscal year 2025 for Equinor was a year of strong deliveries in the face of geopolitical tension and market uncertainty. The company has successfully navigated a lower price environment through record-breaking operational performance and cost control. The strategic pivot toward value over volume in renewables and the reduced capex outlook are pragmatic adjustments to prioritize shareholder returns and balance sheet strength.